$4 trillion recovered in just 30 hours. While you were watching the headlines, institutions were buying what retail panic sold. Gold, up 11% from the bottom. Silver, up 20%. But here's what they're not telling you. China just published an official government document revealing their endgame for gold. The vaults are draining, 2.8% gone in a single day. In Singapore, ordinary citizens queuing outside banks, not to sell, to buy. The final battle for precious metals has already begun, and most investors have absolutely no idea what's coming. Welcome to Silver Collapse Coming. If you've been following financial markets for decades, if you remember when sound money actually meant something, then you're in the right place. We don't chase hype here. We analyze what the institutions are doing while the crowd is distracted. If this kind of strategic economic analysis resonates with you, hit that subscribe button. It helps us continue delivering unfiltered market intelligence to serious investors like yourself. And tell us, where are you watching from today? Are you in the States, Canada, Europe, or perhaps somewhere else entirely? Drop your location in the comments. It's always interesting to see how global this precious metal story has become. Now, let's break down what just happened. Between Friday's market close and Monday morning, something extraordinary happened in the precious metals market. $4 trillion in market capitalization returned to gold and silver in just 30 hours. Gold climbed 11% from its bottom, surging back above $4,800 per ounce. Silver rocketed nearly 20% higher, reclaiming the $88 level. Together, these metals added roughly 35% of what had been wiped out in the recent $11 trillion sell-off. But the reversal itself wasn't the real story. The real story was who was buying and who was selling. While retail investors were panic selling their positions, institutions were quietly accumulating. The data reveals a pattern that professional traders recognize immediately: forced liquidation on the way down, followed by a short squeeze on the way up. This wasn't random volatility, this was orchestrated. Consider the trading volume. The largest silver-backed ETF, known as SLV, recorded $41 billion in trading activity on Friday alone. That single day of volume exceeded every individual stock traded anywhere in the world. Not Apple, not Microsoft, not any tech giant. Silver, a metal that mainstream financial media barely discusses, became the most actively traded instrument on the planet. Retail investors don't move $41 billion in a single session. That's institutional money. That's algorithmic trading. That's large players executing predetermined strategies, while smaller investors react emotionally to price movements. The pattern becomes even clearer when examining physical markets versus paper markets. In Singapore, a very different scene was unfolding. At United Overseas Bank, the only major Singaporean bank offering physical gold bullion to retail customers, lines formed outside the entrance. Despite gold prices falling sharply, ordinary investors were queuing to buy the dip. They weren't selling in panic. They were buying what institutions had shaken loose from weaker hands. The disconnect between paper and physical markets revealed itself in the premium structure. Shanghai silver spot prices traded at $94, while Western spot markets showed $88. Shanghai futures briefly touched $102 before settling back. That's a premium of roughly 20% above Western paper prices. When physical metal trades consistently above paper derivatives, it signals one thing: the paper market is disconnected from physical reality. The premium had compressed slightly after the bounce, down from even higher levels during the crash. But it remained elevated. Physical buyers, the people actually taking delivery of metal, were willing to pay substantially more than the screen price suggested the metal was worth. Meanwhile, vault inventories told another story entirely. In a single day, 2.8% of available silver stock vanished from registered vaults. Not transferred, not reallocated. Gone. At that rate of depletion, the available supply doesn't last long. And this drainage occurred during a price crash, when conventional wisdom suggests physical buying should slow down. It accelerated instead. One major bullion dealer, Bullion Star, reported having only one single 1,000-ounce silver bar remaining available for pre-sale. These aren't retail products. These are industrial-sized bars, the kind that large buyers and commercial users acquire. When dealers specializing in wholesale quantities run out of inventory, it indicates demand from serious players, not casual retail interest. The open interest data from the CME, the exchange where silver futures contracts trade, showed something equally revealing. Despite the violent price action, total open interest in silver futures dropped by only about 5,000 to 6,000 contracts, settling near 142,000 contracts. Compare that to the silver squeeze attempt back in 2011. When open interest exceeded 250,000 contracts and volatility spiked all the way to 138. The current situation showed nowhere near that level of speculative excess. This wasn't a retail-driven frenzy like the meme stock era. This was something different. The $4 trillion recovery in 30 hours, the record ETF volumes, the physical premiums, the vault drainage, the dealer shortages, all pointed to the same conclusion. Large institutional players had used algorithmic selling to create a cascading liquidation event, flushed out leveraged retail positions, and then quietly accumulated physical metal and long positions at artificially suppressed prices. The question wasn't whether manipulation had occurred. The question was, why now and what comes next? On the official website of China's central government, a document appeared that most Western investors never saw. The article, written by Xi Jinping himself, carried a title that translated to Building a Financial Power, but the English version available to international readers and the Chinese version, distributed domestically, contained notable differences. The Chinese version outlined 6 core tasks for achieving financial dominance. At the very top of that list, above all other priorities, stood one objective: establishing a powerful currency. And according to the document, the prerequisite for currency power wasn't military strength, or technological innovation, or even GDP growth. It was gold. Specifically, the article stated that gaining pricing power over gold required becoming the world's #1 producer, the largest consumer, the biggest importer, and possessing the world's largest reserves. China, the document revealed, was positioning itself to meet all 4 criteria. The article appeared in Qiushi, the Chinese Communist Party's official theoretical journal. Its publication on the government website was described internally as the September 3rd military parade in the financial sector, a reference to China's massive military displays that showcase readiness and strength. The implication was unmistakable. China considered itself close to completing preparation for what the document called the global gold final battle. The phrasing wasn't metaphorical. Chinese policy documents don't use dramatic language casually. When official communications reference a final battle, they're describing actual strategic confrontation. The article stated plainly that gold defines the value of all national currencies and determines the new international financial and monetary order. Whoever controls gold pricing controls currency valuation, which ultimately controls economic power itself. China was announcing, in writing, that it intended to be the main player in this confrontation, but declarations mean nothing without action. So what was China actually doing? The data revealed a massive discrepancy between official reports and actual purchases. In November, China officially reported adding 0.9 tons of gold to its central bank reserves. Independent analysis of import data, refinery throughput, and domestic consumption patterns suggested the actual figure was closer to 10 tons. That's 11 times more than officially acknowledged. September showed an even wider gap. Official reports claimed minimal additions. Actual accumulation appeared to be approximately 15 tons, roughly 10 times the publicly stated amount. This pattern of underreporting wasn't accidental. China was deliberately concealing the true scale of its gold acquisition strategy. By publishing minimal official reserve increases, the country avoided triggering alarm in Western markets, prevented premature price spikes, and maintained favorable purchasing conditions while continuing to accumulate. The strategy made perfect sense from a game theory perspective. If China announced its true reserve levels, every other central bank would immediately rush to increase their own gold holdings, prices would spike, accumulation would become exponentially more expensive. By hiding actual reserves, China maintained the ability to acquire at relatively stable prices, while other nations remained complacent. But the underreporting revealed something even more significant. If China was buying 10 to 11 times more than officially stated in recent months, what did that imply about total reserves accumulated over years? The official figure showed China holding approximately 2,000 tons of gold in central bank reserves. If the underreporting pattern had persisted for an extended period, actual reserves could be 20,000 tons, 30,000 tons, or more. Nobody knew the real number, and that was precisely the point. The Xi Jinping article hinted that revelation might be approaching. The reference to completing preparation and the one final battle suggested China was nearing a point where concealment would end, and true reserve levels would be disclosed. When that announcement came, if it showed reserves 10 or 20 times higher than Western analysts believed, the entire global gold market would reprice instantly. Every central bank holding dollar reserves would face immediate pressure to diversify into gold. Every treasury official would be forced to reconsider their nation's reserve composition. The psychological impact alone would be devastating to dollar confidence. China wasn't just buying gold to protect against inflation, or hedge currency risk, or diversify reserves. China was accumulating gold to reset the global monetary system with itself at the center. And the $4 trillion reversal in precious metals was just the first tremor. While China accumulated in secret, Washington was preparing its own response. In late January, The Trump administration unveiled something unprecedented in modern American economic policy: a $12 billion critical minerals stockpile program designed explicitly to counter China's dominance in strategic resources. The announcement came with specific funding mechanisms already in place. $10 billion would come from the United States Export-Import Bank, with an additional $1.67 billion raised from private capital. This wasn't a proposal, this wasn't a study, this was operational funding, ready to deploy. The stockpile's focus extended beyond traditional precious metals. It included lithium, rare earth elements, cobalt, and other materials essential for modern technology and defense systems. But gold and silver sat prominently on the acquisition list, metals that serve both industrial purposes and monetary functions. The timing revealed everything about Washington's awareness of the strategic situation. For decades, American policy treated gold as a relic. Federal Reserve officials publicly dismissed precious metals as barbarous remnants of primitive monetary systems. The official position maintained that fiat currency backed by economic strength and military power needed no hard asset foundation. That narrative was crumbling. By launching a critical mineral stockpile explicitly designed to counter Chinese dominance, the United States government was acknowledging several uncomfortable realities. First, that China had already secured commanding positions in strategic resource supply chains. Second, that those positions represented genuine national security vulnerabilities. Third, that precious metals weren't relics. They were strategic assets that determined geopolitical leverage. The government was telling citizens, in official policy language, to acquire real assets before currency devaluation accelerated. But Washington faced a problem that Beijing didn't. China could accumulate secretly through state-owned enterprises, undisclosed central bank purchases, and proxy buyers operating across global markets. The United States, operating within a more transparent system with congressional oversight and public reporting requirements, couldn't hide large-scale accumulation the same way. Every significant purchase would be visible. Every major acquisition would move markets. Every policy shift would trigger immediate speculation about dollar weakness. So the stockpile program served dual purposes. Officially, it secured critical materials for industrial and defense needs. Unofficially, it provided cover for precious metals accumulation without explicitly admitting that dollar vulnerability required hard asset backing. Meanwhile, a separate crisis was accelerating the timeline for both nations. Japan, America's largest foreign creditor, was facing its worst debt crisis in modern history. The country's debt-to-GDP ratio had reached 250%, more than double America's already concerning 120% level. For 3 decades, Japanese investors had funded American deficit spending through a simple arbitrage trade. Borrow yen at 0% interest, convert to dollars, buy United States Treasury bonds paying 4 to 5% yields, pocket the difference with minimal risk. That trade had just broken. Japanese 30-year bond yields hit their highest level since these instruments were first issued. Yields climbed to 3.7%, narrowing the spread with American treasuries to a mere 30 basis points. When accounting for currency fluctuation risk, the carry trade no longer made economic sense. Japanese investors, who collectively held $1.22 trillion in United States debt, more than any other foreign country, were beginning to pull capital back home. The repatriation wasn't happening all at once, but the direction was unmistakable. Hundreds of billions of dollars, potentially the entire $1.22 trillion over time, would exit American treasury markets. When bond supply increases and demand decreases simultaneously, yields spike violently. When yields spike, everything else reprices lower. Stocks, real estate, corporate bonds, anything valued based on future cash flows discounted at treasury rates, falls. The S&P 500 had already dropped 2%, erasing over $1 trillion in market capitalization. Treasury Secretary officials were reportedly calling Japanese counterparts, requesting intervention to calm markets. The Federal Reserve had begun supporting the Japanese yen, an extraordinary step showing how desperate the situation had become. The dollar was being dumped at the fastest pace in at least 2 years. 10-year Treasury yields were approaching their highest levels since August. This was the real reason precious metals had experienced forced liquidation the previous week. Margin calls were spreading across the system, and leveraged positions in everything, including gold and silver, were being liquidated to meet cash requirements. But the bounce revealed something critical. The underlying bid remained intact. Two forces were colliding in real time, and the $4 trillion reversal in 30 hours was merely the visible surface of something far larger unfolding beneath. On one side, systemic financial stress, Japan's carry trade unwinding, treasury yields spiking, dollar liquidity evaporating at unprecedented speed, margin calls forcing liquidation across all asset classes. The machinery of the existing financial system straining under weight it was never designed to bear. On the other side, physical scarcity, Vault inventories draining, dealers running out of wholesale bars, premiums expanding between paper and physical markets, citizens queuing outside banks to buy metal while screen prices crashed. The fundamental reality of limited supply, meeting accelerating demand from actors who understood what was coming. These weren't separate events. They were connected elements of a single transition. The stock market was entering what analysts recognized as a final bubble phase. Concentration had reached record levels. The top 10 companies represented a larger percentage of total market capitalization than at any previous point in history. When structures become that top-heavy, they don't correct gradually, they collapse suddenly. But while equity markets climbed toward unsustainable valuations, precious metals and strategic commodities were outperforming dramatically. Gold had gained over 50% in the previous year. Silver had nearly doubled. This divergence, stocks rising on multiple expansion while real assets surged on fundamental demand, was precisely the pattern that preceded major monetary regime changes. Something was seriously wrong, and informed players were repositioning accordingly. The question facing every investor, every institution, every sovereign wealth fund was simple but profound. Would the forced liquidation resume, taking precious metals lower as systemic stress intensified and margin calls spread further across leveraged positions? Or would physical shortage and strategic accumulation drive the next major leg higher, as China's endgame and America's stockpile program competed for finite supply? March was approaching. For those who understood commodity markets, March carried specific significance. It was a major delivery month for COMEX futures contracts. Registered silver stocks, the metal actually available for delivery against expiring contracts, had been depleted steadily for months. If a significant number of contract holders demanded physical delivery in March, and available registered stocks couldn't satisfy those demands, the exchange would face a genuine crisis. Either defaults would occur, destroying confidence in paper markets, or prices would spike violently to attract metal from other sources. The unresolved tension sat exactly there. China was accumulating 10 times reported amounts, executing a multi-decade strategy to reset global monetary architecture with gold at the center. America was launching a $12 billion critical minerals stockpile to counter that exact strategy. But Japan was pulling over $1 trillion from treasury markets, creating liquidity stress that forced asset liquidation. Physical dealers were sold out of wholesale bars. Vaults were draining nearly 3% in single days. Singapore citizens were queuing to buy despite price crashes, and March delivery deadlines were approaching, with registered stocks at levels that made default scenarios mathematically plausible. Every previous precious metals bull market had ended when either supply increased dramatically or demand collapsed. In this cycle, supply was contracting while demand from the most sophisticated players, central banks and sovereign wealth funds, was accelerating. The $4 trillion recovered in 30 hours proved that beneath the paper volatility, beneath the forced liquidation, beneath the margin calls and algorithmic selling, a fundamental bid existed that couldn't be shaken out. Because the players providing that bid weren't trading for profit. They were positioning for a monetary system transition. China's official government document didn't discuss trading strategies or investment returns. It discussed the final battle for gold pricing power and building a financial power through currency strength backed by the world's largest reserves. America's critical mineral stockpile wasn't marketed as an investment opportunity. It was framed as national security infrastructure, essential for maintaining strategic independence. These weren't market participants. These were nations, preparing for confrontation over the architecture of money itself. The volatility wasn't the problem. The volatility was revealing the transition in progress, separating those who understood from those who didn't, shaking out weak hands while strong hands accumulated. And for investors who recognized the pattern, the message was unmistakable. The question wasn't whether to hold precious metals. The question was whether current positions were adequate for what was approaching.